Okay, hi all. Can everybody hear me okay? Yes. Well, somebody can. Hey, David, nice to speak to you again. It's been, what, an hour? Right, we have to do a disclaimer first. I'll let you read that. For those that didn't come on the group therapy before, this is an interactive session. This isn't something we script. This is something that we do a two-way thing. So I try to bring a topic to you and then we discuss that. And so what we're going to talk today is we're going to talk about edge. We're going to talk about setup, and we're going to talk about that twilight zone between when you take a trade and when you feel that trade is working out. Now, there's a few reasons we're going to do that. What I'm first going to ask you is, would somebody like to give me the definition of an edge? What do we think an edge is? Anyone like to have a stab at that? What's an edge? An advantage? Yeah, I think so. That's a good repeatable advantage. Yes. Something that works with enough probability over the other. Someone saying support or resistance, possibly. CPT. I don't know what CPT is, Joe. Yeah, probability of one thing happening over something else. Repeatable statistic probability. Yeah, I think these are good definitions because quite often you hear things like people saying the markets are too efficient now. And when the implication of that is that there's no opportunity. When actually the markets move around a lot. And if the markets move around a lot and those moves are somehow predictable, we can get something out of them. So the way I define an edge is the ability to spot something occurring in the markets in time to exploit you. Robot man said, when a girl winks at you, you have an edge. I don't know. That's many years ago since I've been winked at. But anyway, if you can spot something occur in the markets in time to exploit it, generally speaking, that would be talking about a move in the market, but you can have an edge that gets you into a trade and out of a trade without the market moving. So if you look at things like the 2-year treasuries, where there's literally 10, could be 10,000 bids and offers each side or at each level, you can get into and out of that market just by manipulating the queue. So it doesn't necessarily have to be a move. So we all actually agree on what an edge is. So what then is a setup? Is a setup something that's different from an edge? I like Marvino's definition there of an edge. He's saying statistical advantage that is not universally known. And that's probably something better for a different day, but that is certainly food for thought about how well an edge can be known before it's traded away. So a set of circumstances possibly, but that's similar to the edge. Your playback. David's got a great definition. A setup to access your edge, which I think is a good way to put it. Execution proposal, applying the edge consistently. Number of things to happen before you take a trade. A recurrent pattern, a precursor to the edge. These are all very good definitions, but I'm going to hopefully expand on what setup is. Okay, so usually the setup's defined, as you've all mentioned, the rules to get into a trade to exploit an edge. Now, I have this mindset, same mindset as you, where I tend to think that a setup stops at the entry, right? So we tend to look at quite complex things. We look at lots of different things. We're looking at order flow. We're looking at volume profiles. We're looking at market profile. We're looking at all these different things for the setup. And that's all focused entirely on getting into the market. So we might have this really complex thing that we've studied and we've been to Jim Dalton's school and all that kind of thing. Just give me 2 seconds. Just got to answer this. Sorry, I had to answer a message there that should be off. Right, so we can define this really complex way of how we enter the market. And then what do we do once we got in? 10-tick target, 5-tick stop. And that's kind of the opposite, isn't it? It's almost as if that all of that energy went into the setup, the actual point at which we get into the market, and there's no energy or there's no IQ or there's no knowledge left to actually manage the trade. And that's really what I want to look at today, because I think really a setup shouldn't really just stop at entry. Okay, so let's just look at a potential setup. So imagine this is a chart and this is a pullback, right? So most people would say that a pullback setup is trying to get this area here. It's trying to get an entry there, right? But that's not the only place you could trade that pullback, right? So you could go short here. You could go short here. You could go short here. You could go short here, or you could go short down here, right? So the setup, there's one potential setup here, but there's lots of different places you could get in, right? And so the edge, if you like, the edge really there is in knowing that the market's going to continue down, right? Would you agree with that? That's the edge, right? The edge is knowing that the market's going to continue, right? But the setup could be here, or it could be after there, or you could be playing the break down here. They're all setups, but to me, it's the same edge. Now, if you get in here, you know, so if you get in here, basically, you're effectively saying you're going to suffer through the pullback and wait for the break. The way you manage that trade is going to be different from if you enter here, right? Would we agree with that as well? I'm going to have a bigger stop, for instance, right? So if the edge can be anywhere really, as long as I make money, then depending where the setup is, surely it should change how I'm going to manage it. I'm going to look at some specific setups and try and work through that today. But I want to talk about two other different things that are also important when we come to managing, right? So with trading, how many directions can the market go? Yeah, okay. That's you're trying to be clever. It can't go three ways. It can only go up or down. If it doesn't go sideways, right? Market doesn't go sideways. I'll tell you why a market doesn't go sideways, because charts are the charts are fictitious. The market can only move up and down. It's on a fixed vertical price scale, right? The fact that you see it moving sideways is because you're plotting it along a timeline. But the market doesn't really move along a timeline. It just moves along that vertical price, right? So really, it can go up or down, right? It never goes nowhere forever. It always goes up or down. So one of the things that we know, that if a market only has two directions, you can toss a coin and you should win 50% of the time. Now, has anybody ever won less than 50% of the time? Yes. Okay. And so, yes, yeah, Joe's laughing. Right. So how is it possible? Look, if the market can only go up or down, then why do we see people losing? I mean, I used to have times when I was first starting this, I could lose 20 trades in a row. I mean, I could literally lose every trade. But if I'd have actually flipped that around, if I'd have actually gone long where I was going short and short where I was going long, I would have still lost 20 times. Because there's a difference between being right and being right now, right? So I'm right that it's going to go up, but some of my trades, I need it to go up immediately, right? And there's a big difference in probability to it's going up and it's going up in the next 10 seconds, right? So one of the things that we have to think about with the management, obviously, is first of all the timing, and also like the overall volatility. So the times that I would literally go trade after trade after trade losing, I was basically either putting a too small stop in, which is one thing, poor risk management, no patience, but also I was chasing the market. So I'd go long and the market would go up. So I'd chase the market up and I'd be going, so I'd go long and the market would go down. So I'd stop out of that and then I'd go short to try and get with the market, and then it would turn around back up. And I was trying to trade within that kind of normal level of volatility on the time frames that I was trading. So, you know, if the market's like moving up on the S&P, it's, you know, normally with a move, if you're looking like the middle of last year, you'd look at 4, 5, 6 ticks of wiggle in any move up. It can easily drop down 4, 5, 6 ticks without really being a pullback. Obviously, there's a bit more now. So if your stops are within that range, then there's not really much you can do in trade management that will kind of protect you from that. So if you know, if you get in, for instance, with a 1 tick stop, it's going to be very, very difficult, you know, especially a market order with a 1 tick stop, because the bid, if you go by market, the bid's going to be, your stop's going to be where the bid inside bid is, right? So you can get stopped at immediately. So before we look at management, obviously we're talking about being right today. We're not talking about being right now. So if you do have this really, really high loss rate, it's because you're trying to be absolutely right now. And then the other thing that is really, really important to understand, and it's a weird thing, how many of you are able to read the market better if you're in a position? No, okay, that's interesting. Okay, that's a mix. I would thought there'd be more, right? Some people say yes, of course. Some people say no idea, right? Most traders I know that have been at this a while are much better at reading the market once they're in a position. Okay, so how many of you find it easy to know that you're going to get stopped out? Let's kind of change the question a little bit. Are you ever in a trade and you know that you're going to get stopped out, right? Because maybe not. Okay, so I can be watching a market and I've got really absolutely no idea if it's going to go my way or not. But once I'm in a trade and I can see the market moving around my position, I can tell a lot easier. But if I'm not in that trade, I can't tell where the market's going, right? So you can put me in the same market, the same time, the same spot, the same market. And if I'm in a position, I can tell where it's going a lot easier than if I'm not in a position. And it's a bit frustrating if you think about it, right? Because when I'm in the position and it's going down against me and I know I'm going to get stopped out just because of the amount of trade that's hitting the market, I often wonder why I couldn't just not have a setup at all and just wait until I see that thing. Yeah, there is something about being in a position that gives you more, as Vincent's saying now, that gives you a lot more focus. And so the other thing you got to think about with trade management, now if you're not very good at reading order flow, it really hasn't clicked with you yet, you're probably not going to experience this, right? It is partly it's because your position's highlighted on the dome, Clive, but also there's something that happens when you've actually got money on the line, that your state of mind switches and you become more focused. And I don't know if that's like an animal thing, like your lizard brain. I could probably call Rich Friesen and ask him to do a session on it. But anyway, sometimes you just know the trade is failing. And so you've got this set of skills that once you're in a position, you've actually got a different set of skills at play. So we've got the setup itself, we've got the edge, we've got the setup, and we've got this state of mind switch, right? And those are all three things that are going to come into play when we manage a position. And I do know traders that will actually take a position in a market just to get a feel of how that market's acting. Now, sometimes they're just trying to see how quickly they get filled, to see how much liquidity is there. But a lot of times it's just to try and get into that state of mind, right? Now, if you're not experiencing that right now, then it's just something to be aware of. And if you're not experiencing right now, send me an email and let's have a chat about doing some more order flow drills. It's unconscious competence, yeah. but it's weird that it comes in when you're in a position. So with all these things in mind, right, I'm going to go through a few setups, and we're going to think about what should we see once we get into the market, right? So now if you can give me a setup later and we can talk about it, right? So I'm not going to use charts. I'm not going to use the dome. I'm going to be a bit abstract, but if you don't understand this, then let me know. So what we see here is a market that's moved up. There's a big cluster of volume on the volume profile. So the market's been in a trading range for a while. And one of the setups that we advocate at Jigsaw is the market breaking that trading range, coming back to the top of the trading range, and then moving up. Okay, so whether you agree with that or not, do you actually understand the concept? Okay, good. So all we're saying is we have a clump of volume here, recent volume here. The market breaks out of that volume, comes back to the top, and then it moves up. Okay, so that's something that we expect to happen. So the first thing, if we want to manage that trade, right? So where should we get in? Where's the best place to get in? Yeah, top of the profile, near the volume cluster. Okay, would you say it's better to get in before or after? Yeah, David, depends on your taste for risk. Yeah, so some people saying they'd get in before, some people they'd say get in after. Right. Now, if we think about it, we're setup focused generally, which means once we're into a trade, we put a lot of thought getting into the trade, but once we're in the trade, we kind of sitting back and let it work. So what we're talking about today is to not be doing that. So let's just think about it. At what point would we know this trade is working? Yeah, next saying, shouldn't we see this on the dome? Absolutely. But I'm saying, what should we see? Right after the pullback, right? So some people are saying we know the trade is working when it breaks the high. Okay. When do we know it's not working? Yeah, maybe a rotation down, falls back into the profile. Yeah, break the volume node, bottom of the profile violated. Actually, a lot of us say top of the profile violated. Okay, so some good answers there. But what we're talking about there, we're all talking about a location, right? We're talking about trade location. So we're saying if we go back down past this trade location, it's failed. If we go past this trade location, it's worked. Okay, so the reason for getting into this trade, right, in theory, right, the reason that we get into this trade is because we believe that this cluster of volume here represents positions, and we've got long positions and short positions in there. When the market breaks out to the upside, the short positions, the sellers there, get stopped out. And then when we come back down to the top of the profile, the buyers defend it and the sellers just don't sell again, right? So the sellers don't want to sell again. And so we should see the market fade away. But who's getting in? So we look at why. We think the why for this trade is we come back here and the sellers don't want to sell. But what is making this move happen? Right. So let's think about this. This move here, what is that? Is that people getting stopped out? Is it people initiating new positions? What's the reason for this move here? Yeah, more aggressive buyers and sellers. Value rejected. Okay, so some good answer, but with the market, right? So one of the answers there is value rejected, and so the question now to Hannah and the others, how many times have you traded the market and you said to yourself, I don't like the value of that, I am rejecting it? Yeah, okay. Never. Nobody I know has ever said, I don't like that value, I'm rejecting it. Go, value. Go away. So these are some like concepts that we hear in the market that sound really cool, but actually when you come down to it, it's like, what's it mean? Who's rejecting volume? I've never heard of anybody saying, oh, that value, I mean. I've never heard anybody say, oh, that value is horrible. What is happening, in my opinion, with the market, all of you guys in this room are doing one thing. You're trying to guess where the market's going, right? Is there anybody here that's doing anything other than trying to guess where the market's going? If you're a guesser, if you're trying to guess where the market's going, just type the word guess. Guess. Yeah. So we're all trying to guess where the market's going, right? So, and if we think the market's going away, what are we going to do? What are we going to do when we think the market's going in a particular direction? Yeah, James, could be spread trading. Yeah. But they're just trying to guess as well. Right. We're going to get on board. So here's what I'm going to suggest, right? I'm going to suggest that the stop run was here. So when the trades got stopped out, there was a stop run here. On the way down, we probably didn't get many traders stuck on the way down, or there will be some sellers. There will be some people selling on the way down that will get caught offside. But I'm going to suggest to you that this move up is simply all of the people trying to guess what everybody else is doing, thinking that everybody else is going to trade to the upside. In other words, thinking that the path of least resistance is to the upside because the area held. Okay, so if there's an area where is it a self-fulfilling prophecy? I think it kind of is, but kind of not. You're saying they're typical retail traders. I would also add typical prop traders. Everybody wants to pile on a move, right? So if you watch the number of contracts trading as a move up happens like this, like if you look into the S&P, you'll see like loads and loads of 100-lot orders hitting the market on the way up. They're not retail traders. They're prop traders, right? So what's happening here? Now, and I'm gonna walk you through this. We'll look at some other examples. So here's my interpretation of what's happening. The stops drive the market up. Market comes back down. It's a weak move, probably fairly balanced, but there's not really a significant amount of orders in any one location on the way down usually. And this move up is really going to take off when people think, you know what, it's going up again. And that's what's making the move up. I don't think there's really anything more than that. In that case, if we're managing this trade, let's say we got long here. If we're managing this trade and we believe that at some point the kind of crowd is going to decide that, yeah, it's going up, what are we going to see? Vincent's saying delta up. Yeah, I would say an increase in delta, an increase in volume, larger orders, energy up. Yeah. Now, Jan, you're saying a fast move. I'm going to say it might not be that fast. It won't be as fast as a stop run. So you're going to see more people willing to participate. So if you get into a trade here and it starts ticking up and it's weak, and it starts ticking down and it's weak, and it's not really doing anything, then you haven't seen the move yet that you're expecting. If it ticks your way 5, 6, 7, 8 ticks and it's still weak, there's still really no excitement, is that confirmation that your trades are going to work, that that the market's going to go your way? No, okay. So in this scenario, we don't really have traders trapped for a stop run. We do have a good reason for a trade, but the reason for the trade is really a lack of sellers. And if there's a lack of sellers, there's probably not going to be that many stops. So really, for confirmation on this side, we just want to see a decent amount of trade coming. We just want to see the market pick up, right? Would that sound reasonable? Now, from a jigsaw perspective, you've got you've got the balance of trade, you've got the pace of tape meters, but generally speaking, it's just the current trades where you're going to see that. So that's the first one. Right, another pullback. Okay, so same deal, absolutely same deal. Market moves up, market moves back down. This time, we've got an iceberg order. On the bid side, we've got a lot of selling. They've sold into the area. And let's say it's the S&P, it's all at one price, right? So if this trade works out, what's the reason it's working out? Or what's, based on the reason we're getting in the iceberg, what's going to make the trade work out? Well, yeah, good, some good answers. So a lot of you talking about what's happening here. We know the seller's trapped. What if, okay, so let's have a different one. What if this is two-way? What if this is a big iceberg, but we got like 3,000 at the bid and 3,000 at the offer? At what point would we know this is working? Maybe tick up. Okay, at what need or info? Yeah, when they bail. Okay, good. So what point would we know this is not working? Yeah, kind of when the buyers bail, a side is pulled. Okay, so here's the thing with, it doesn't go up, down, ticks quickly. Here's the thing. If you've got 3,000, let's say we got 3,000 each side, or let's just say we had 100 trade at the offer, but we had 3,000 trade at the bid. If 3,000 traded at the bid, you got the bidder who bought 3,000 and the seller who sold 3,000. We know it's not just one person. Let's keep it simple, right? So you've got 3,000 buys, 3,000 sells, right? You know when this trade has worked because one side's going to get stopped out. You don't know which side it is, but you know one side's going to get stopped out, right? So let's say there were 3,000. Let's say there were 3,000 contracts traded there. About how many? What would we say would be a good amount of contracts to be stopped out from the area? Yeah, couple of good. I think that's a good answer, Amy. Maybe a couple of thousand, because we don't think all of the we don't presume that all of the traders in an area are long term, right? But a couple of thousand, 2,500, 2,000, something like that. Yeah, half or better. So for this trade to work, we need them to stop out to the upside. For it to not work, we need them to stop out to the downside. So considering we just looked at a trade where the pullback wasn't on particularly high volume, there's no iceberg, what would we look for differently to confirm or reject this trade? Oh, it's a difficult one. A stop run. Yeah, you're going to see changes in the bid ask. You're going to see a lot of things, correlations, but ultimately, you know when this trade has worked because there will be a stop run, right? So the iceberg might be your setup, but the stop run is what tells you that you're okay. So the stop run would be something like on the S&P, you would move up 5 or 6 ticks, like boom, 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 straight away. And because the stops would trigger and you'd get a cascade. And the same thing to the downside, right? So the difference between an entry here and an entry here is the confirmation for this trade would be a stop run. And that should be visible. Should we be able to see the difference between the stop run here and just people generally joining the market, or more and more people joining in to confirm this trade? Should we be able to see the difference? Yes, absolutely. How many of you are right now are looking for that difference to confirm your trades? Good, Andres. Some are, some aren't. Good. For the people that aren't, then that's why we're doing this, right? So if there's an iceberg there, there's a couple of things you can do. First of all, you can usually have a stop that's fairly close because it generally doesn't get the other side. And if it does get the other side, it generally runs through it pretty quickly, right? So if you have an iceberg, if you have an iceberg on the S&P and it gets the other side of it, it doesn't generally stay the other side of it for long, right? So if an iceberg fails on the S&P, my experience, and I don't know if your experience is, you put Y in if this is the same for you. My experience is that if a market moves down, there's an iceberg on the bid. If we go through that iceberg, we don't stay in that place for long. We hit through 3 or 4 ticks pretty quickly. Is that your experience? You know it's an iceberg, Joe, because there's just a huge amount of contracts traded there, right? Now NX is saying it's too late to enter, right? It is never too late to enter, right? You could enter when you see the stop run, right? It just depends on your experience with that market. If you're in a market like crude oil and you entered when you see the stop run, it's probably still going to go up 30 ticks. There's not really a too late. So if you think about the edge is the fact that it's going up. The setup can be here, could be here, could be here, could be at the iceberg, could be, it just depends how much confirmation you need. Okay. Usually if it hits through, it'll keep going down. Right. So what we're saying, a pullback to an iceberg is a completely different trade when it comes to management and should probably have you looking at different things at least before you start to relax and let the trade run. You know, there's that time where you want to just get that first push away from your entry point. Right. No, this isn't scalping, Joe. This is really just trading. This is really just leaning on order flow events to get into a trade more than anything. It's just early trade confirmation more than anything else. Right. So a pullback fade. A fade is when you just run out of counter trend traders. A fade. It's my favorite trade, right? And it's when, like, you know, it's been great on the S&P the past few weeks. When the market picked up, there were just too many false signals when the market picked up at the end of last year. But the pullback fade is effectively where you've got a trend that's doing, you know, a nice trend. There's good pace to the market, and then the market starts to tick back. Now on the S&P, sometimes that tick back is only like 4 or 5 ticks. It's not like a full pullback, and you won't see that pullback really on a chart, but it's just kind of a move back, and you'll see the market move back, and you'll see the down the Nasdaq move back as well, and it will just die, right? It will just stop. And, you know, a few seconds will pass and you might see another couple of trades, but just really lazy trading, right? So if you see that lazy trading, can somebody tell me the benefit of entering here with the fade pullback as opposed to the iceberg pullback? Is there any benefit to entering here? Is there any reason that might be a better trade? Vincent says no manipulation. Vincent, why is there no manipulation? You're right. Slower trade, also right. Sellers exhausted, absolutely. Well, no. So the thing is, an entry here, right? Or let's say there are 3,000 contracts traded here. So market moves down, we get 3,000, 4,000, 5,000 contracts trade. That is something that will be brought to the attention of people that nudge the market around to get people out of position, market makers, the sharks, right? So if there's 5,000 or 6,000 contracts at 1 or 2 prices, somebody might, you know, hit 500, 600 contracts of that just to try and stop people out. When you get to this setup here, it's exactly the same setup, right? Market has pulled back, but there's nobody at the extreme to nudge around. There might be 20 or 30 contracts traded at the extreme, right? So there's a big difference. There's no benefit in trying to nudge 20 people out of position, right? So from a trade management perspective, that changes things, right? You agree? Because there's nobody to push out a perspective. So absolutely. So for a pullback fade, what do we want to see? What do we want to see? If the market's going our way, what are we expecting to see? We've already talked about it. What would we expect to see? We'd see some volume. Would we see a stop run? No. Good, Amy. So there's no stop run because there's nobody to stop out, right? So it's like there's a weak pullback. So the best thing we're going to see for confirmation is just for the momentum to come back into the market and to see some size coming back into the market. So other than that, you're not going to see much. Now, again, what about move against you? What would you see? What would you expect to see that tells you the market's actually failing against you? Yeah, hitting hard into the bid, sellers jumping in, a bit of acceleration, more aggressive volume. But you're probably not going to see much more than that because there's nobody stuck there that's going to get stopped out when you move down. It just means it'll pick up that, obviously the sellers have decided, there's enough sellers that have decided that, the move down is where it's at. Right. So we got 3 trades there that are exactly the same, but different reasons to actually get into the market and different things going on. The other thing about the pullback fade is, in my experience, it's just that you can get in a bit sooner and there's less people looking for that trade. It's just a nicer trade to get into. Right. Momentum trade. Right. Momentum trade is basically markets moving up. You get in anywhere. Right. So let's just put the cursor somewhere. Okay. So in a momentum trade, why would we get into a momentum trade? What is the reason for getting into a momentum trade? No, it's not fear of missing out. That's a good answer, but I would say there's 2 types of momentum trades, right? Andres, it's not, okay. There's 2 types of momentum trades. There's the type of trade where the market's going up really, really quickly and you think you're missing out. And there's a type of trade when you see the market's going up really quickly and you think it's going to carry on and it's moving up probably in an orderly fashion, or there's a news event that's driving it, right? So the momentum trades, I take momentum trades. John Grady did a good webinar recently on momentum trades. I'm not even sure, I can't even remember where he did it, but he did a good webinar where he talks about just sometimes in a market, it might only happen once every 3 or 4 days. You just get this big run. And that's what prop firms jump on. And the videos that we did, that Axia did, that they added to the price ladder course, some of those were just basically the market was going crazy after Brexit and everybody was just piling on in one direction. The markets were going, the markets really tanked. So when the markets really tanked, there is a good case for a momentum trade. There's also sometimes a market grinds up and it doesn't pull back. And if a market's not pulling back, then again, that's a good reason for a momentum trade. A volume spike you don't want to be involved in. So you'd have to know the difference between the 2. But also with a momentum trade, you're basically, it's a probability play, right? So at any one point in time, what's more likely? The market turns around and does something different, or the market carries on doing what it's doing? Generally speaking, at any one point in time. Yeah, continuation, right? Thank you, Vincent. So it is more likely that a market will carry on. But remember what we said, right versus right now. You got that wiggle. So you've got to still allow for that, right? You've got to still allow for that if you're going to get shaken out of a momentum trade really quickly. So what do you want to see in the trade? To confirm that your momentum trade is good, what do you want to see? Yeah, highs, high and lows, aggressive buying. It just continues. A good answer, Andres. That's it. You want to see the same thing. You want to see it carry on what it was doing. So if it's moving up 8 ticks, pulling back 4, that kind of thing, just up and down on the DOM, and it carries on doing that, that's your confirmation. So you're not going to get this stop run, right? Because there's nobody to stop out, but you're just going to get it to continue. What would you see to get you out of the trade, for the trade to be going against you? Yeah, large pullback, breaks a swing, buyers slow down. Something changes, right? Something changes. Compression snaps back in your face. Energy gap, I don't know what that is, Vincent, but it sounds fantastic and I'm going to start using it. I just got to find something to fit it to. Yeah, there's huge orders. So basically you're going to see a change, right? Okay, so based on, we've got our edge, we've got our setup, and we've got all these other things that we can look at if we think about who am I trading with, why am I trading with them, when should I get in? Okay. Now I'm going to show you another one. Moving average crossover. Okay. How do you manage this trade? Somebody tell me the why. When you get into this trade, what's the why? I know you don't use it, Amy. We're just using this as an example. Everybody said don't show that stuff. Okay. Does anybody have a why? Okay, there's no logic behind it. So if we look at this setup, we can't really tell who's doing what. We don't really have a good story that we can build of what's going to happen when it goes against me, what's going to happen when it goes my way. Is there likely to be any manipulation around this area? Should I see it speed up? Should I see it slow down? We don't really know anything about it, and that's the reason I added it like towards the end, is because you're saying the right thing. It's a setup where we don't actually know much about who's trading. We just know some mechanics, right? So it's a good example. I'm glad you all answered the same way, but basically that's really what I wanted to cover. So the trade, or a trade, is a series of events, right? We've got this thing called an edge. We've got this thing called a setup. One of the events that happens in a trade is you getting in, right? Now, an edge is also a series of events, and some of those events confirm. But basically, does it really matter in terms of your trade? Why does it matter where in that series of events you get in? What's the significance of where on that series of events in the edge or the setup you get in? Risk, better entry. What's the other side of risk? Well, return obviously, but the answer I was looking for was from Hannah. Certainty. You've got risk and you've got certainty, right? So even when we talked about the pullback to the iceberg, and then we see the traders get stopped out, you can get in at the iceberg, which is your highest risk, least certainty. You can get in when traders get stopped out, which is lower risk, more certainty, lower reward. So it's risk, confirmation, and reward, trade-off between risk and price. I'm not teaching you guys anything here. You're giving me all the answers. Okay, and the last question is, does it make sense to put all the smart stuff into your entry and then just use a dumb stop and target to get out? Now, I'm not saying you shouldn't have a stop, by the way, but I'm just saying and I'm sure you don't all do this anyway, because we've been preaching this for years. But again, a lot of people are smart enough to not use a fixed stop and target now. But also, a lot of people are looking for the same thing to